By 2026, the global GDP is projected to hit a staggering $126 trillion. Out of this massive pie, two superpowers, the United States and China, account for nearly 45% of the world's economic output combined. On one side, America sits firmly at the top with a GDP breaking $32 trillion. On the other, China bursts past the $20 trillion mark, sprinting at a growth rate of 4.8%. This economic rivalry has been raging for years. But who will actually come out on top? In the next 8 minutes, we cut through the noise and reveal the truth behind this economic showdown. Let's start with nominal GDP, the standard metric for global economic size. According to the latest IMF projections, the U.S. GDP hits $32.38 trillion in 2026, remaining the undisputed number one. China follows at $20.85 trillion. The U.S. economy is roughly 1.5 times larger. However, the ratio of China's GDP to the U.S. has dipped from 77% in 2021 to roughly 64% in 2026. While China is growing, the U.S. has been sprinting faster in nominal terms, partly driven by inflation and a strong dollar. Look at the growth rates. Goldman Sachs projects U.S. growth at 2.6%, while China hits 4.8%. Swiss Re estimates similar figures at 2.5% and 4.7%. China is growing nearly twice as fast. By 2031, the IMF predicts the U.S. will reach $39 trillion and China will hit $27.5 trillion. The gap is still there, but China is closing it rapidly in relative speed. But nominal GDP doesn't tell the whole story. What if we look at purchasing power? Parity, the true buying power of a currency? The picture flips entirely. IMF data reveals that China's PPP GDP in 2026 reaches a massive $44.30 trillion compared to America's $32.4 trillion. China is ahead by a staggering $12 trillion. In fact, on a PPP basis, China overtook the U.S. way back in 2014. By 2025, China's PPP GDP was already 1.34 times that of the U.S. What does this mean? It means the average citizen in China can buy more goods with their income than the nominal exchange rate suggests. But critics argue that PPP is better for measuring living standards. When it comes to global financial power and currency dominance, nominal GDP is what matters. Two metrics, two different answers. So, where does America hold the unbeatable cards? First, technological innovation. The U.S. leads in artificial intelligence, semiconductors, and aerospace. Most top-tier AI labs are based here. The U.S. controls 44% of global data center capacity and roughly 50% of the semiconductor market share. Second, financial supremacy. Wall Street is the heart of global capital. The depth of U.S. capital markets and the petrodollar hegemony are untouchable in the short term. 9. Out of the top 10 U.S. listed companies by market cap are tech innovators. Third, talent magnet. America remains the top destination for the world's brightest minds. As experts note, the U.S. is the brain of the global economy. Furthermore, Goldman's Jan Hatzius notes that U.S. consumers will receive roughly $100 billion in extra tax rebates in early 2026, giving consumption a massive shot in the arm. But China's hand is equally strong, and it lies in the physical world. First, manufacturing hegemony. China accounts for roughly 30% of global manufacturing value added, more than the US, Japan, and Germany combined. Manufacturing makes up 27% of China's GDP, compared to only 11% in the US. China exports $825 billion in high-tech products, 2.14 times that of the US. Second, the complete supply chain. From EVs and solar panels to batteries and consumer electronics, China is no longer just the world's factory. It is the world's production hub. Third, rare earths. China controls over 90% of global rare earth refining and permanent magnet production. These are vital for AI chips, EVs, and defense. Fourth, green energy. China dominates solar and EV production. By 2030, China is projected to have 400 gigawatts of spare power capacity, enough to power 3 times the global data center demand. However, every giant has a weakness. America's Achilles heel, massive trade deficit, reached $1.1 trillion in 2025, accounting for nearly 2/3 of the global current account deficit. Manufacturing hollowing out, over-reliance on imports for critical goods, soaring fiscal deficits and national debt. China's Achilles heel, weak domestic consumption. Consumer growth lags behind investment. 2025 saw the first negative growth in fixed asset investment in 20 years. Property market crisis, dragging down local government revenues. Lower per capita GDP, only about 1/6 of the US. Tech bottlenecks, still lagging in high-end chips, industrial design software, and biopharma. As analysts point out, these internal problems aren't fading. They are sharpening the divide. The global economy is splitting into 2 opposing technological and economic camps. So, back to the big question. Who will dominate? In the short term, the US will retain the nominal GDP crown, leveraging tech, finance, and the dollar. In the medium term, China's superior growth rate, robust manufacturing base, and green tech dominance are rapidly closing the gap. Some economists predict China could overtake the US in nominal GDP by the early 2030s. But the reality is likely more nuanced. The world might not have a single master. Instead, we are heading toward a dual-core structure, a US-centered tech finance bloc and a China-centered manufacturing trade bloc. The future of this competition isn't just about GDP numbers anymore. It's about industrial structure, technological sovereignty, institutional resilience, and domestic demand. This race is far from over, and we are all living through it. Thanks for watching. See you in the next one.